The mortality rate is very low. And the recovery percentage is very high. So I think we need to move on in life, and what is happening now with regarding opening of the economy. And hopefully, I think over a period of time, everything will be back to normal. Now, coming back to my topic on capital markets. So my respects to all the faculty members over here. And I don't want to make the topic very complicated, so I may talk very basic stuff. It might be boring for some, it might be interesting for some. So please excuse me for that. And it's very difficult to speak in 1 hour about the capital market of the past, the present, and the future. To begin with, let me tell you, everybody has heard about Warren Buffett. And if you type his rules of investing, he has 2 rules of investing. The first rule says, never lose money. That's very easily said. And the rule 2 is, never forget rule 1. So it's a cycle, okay? One thing he also says 1 or 2 sentences which I'll tell you. He says, never invest in a business which you don't understand. So never buy stocks which you think, you don't understand as to what the company is doing all about. And then markets can, they actually can price anything, obviously. A lot of people of you must be thinking that economy is in a very bad shape. Global economy is in a bad shape, but the markets are running. So why is the markets running and all that? Everything comes in your head. So I'll come to that topic as to what I believe and what one should do and what one should not be doing in life. But since I have to talk about the past and what's the present in the capital markets and what's the future, let me quickly take you through the past and not spend too much time in the past. See, I joined the capital markets in 1990, and at least for a good 1 decade, it was very crude the way the markets used to function. There was this outcry system where, the markets used to open from 12 to 2, where you used to go to the ring. It's a place where all of us used to go and used to buy and sell shares, write it in a book there and there. And there used to be a lot of action which one needs to understand whether you're buying or you're selling. The whole business of investing was not transparent. You never knew what price you were buying. You never knew what price you were selling. The entire system used to work on paper. You used to get, for all those who are very senior over here, might still be having some kind of a share certificates, which, in those days, everything used to work on share certificates and share transfer forms. Volumes were very, very low. It was something like 100 crores, 150 crores. And this was the kind of markets which was in the past. There was absolutely very little research. In India, we were not bothered about what's happening in the US or developed markets. We were confined to our own economy. We were confined to our own markets. And this is how the initial phases of the past used to work. But it is interesting to know what happened in the future, or what is happening today. So over a period of time, National Stock Exchange came into play and online trading started. It was a huge change in the way everything used to function. We, over a period of time, had no more physical paper, and that took away a lot of risk from what used to be called as a bad paper or bad debt or bad delivery, where it used to take lots of time for it to get rectified. In the past, when you used to sell stocks, you used to get money somewhere between 15 days to 21 days. Whereas in the present, you get it in the day you trade and you get it after 2 working days. So technology has changed the whole gambit of how markets function today, how the capital markets function today. Everybody sits in his own office, and in today's environment with this COVID-19, we all work from home, and we are trading through our houses. So we have, you people will understand engineering in your engineering terminology much better. We have VPN, which is virtual private network. We connect to the servers, and we can trade from 9 in the morning to 3:30 in the evening in the capital markets. The commodity and currency also, which came up subsequently in the present environment in the last 15 odd years. That's another market which is open till pretty late in the night. In the present scene, the way markets are functioning, or what we all have understood, is that a lot of us have understood the importance of research. The entire markets have opened up globally, and a lot of us stay awake in the night to see what's happening in the Dow, or what's happening in the morning in Japan or Hong Kong or Korea or China. And markets in India also react to markets internationally. The volumes which used to happen 100, 150 crores has gone through the roof. It's become very, very transparent. You can trade on your own online. So actually, you know what price you have bought, what price you have sold. You can go to the NSE server or the Bombay Stock Exchange server and see, put your transaction ID and see what is the price that you have traded. With advent of time, you had the depository system in place, which is nothing like a bank, where all your stocks are kept in a demat form. Actually, all of the engineering students over a period of time, when they get their certificates, I'm sure they can keep it in a demat form so that you don't lose these certificates in a decade or 2 decades. It's kept over there. So like in the past, even this demat has become very, very interesting. In the past, you used to trade gold and silver. So you should actually keep the gold and silver in your lockers or in your house, which was very risky from standpoint of being lost or robbed or theft or whatever. Today on the commodity exchanges, you can buy gold, you can buy silver, and they all are kept in a demat form. So you have a statement from the depositories which say, okay, I'm holding 500 grams of gold or 500 grams of silver for you in demat form. And it's very, very safe. It's like having your money in the bank, in a scheduled bank. And it's pretty, very, very safe there right now. So in the current, early 2000, we also had the launch of derivatives in India. And today we trade the index futures, which is basically you're trading the Nifty futures, the Sensex futures, you're trading options, which is a very big subject on itself because you need to understand call, the put options. That trades seamlessly. Then you have single stock futures. Just to give you an example, on 1st of January, if you want to buy, say, for simple understanding, we'll keep it very simple. If you want to buy, say, Reliance, and assuming the Reliance stock is quoting at 1,500 rupees, but you don't have the money today, but you think, over a period of 1 month, the stock can go up. So you can definitely go to a derivatives market. You can buy a futures market. You can buy Reliance in futures. That's saying that, okay, I'll give you 300 rupees as margin money, but I will take the delivery at the end of the month. So like this, there are exotic products which trade on the derivatives platform. A lot of volumes have surged. And then now there are different kinds of participants also who trade on the markets. You only used to have people who used to come, they buy shares, not speculate so much. Today you have investors who want to buy and keep stock for a very long period of time. They are called, normally in our language, they are called long only guys. They keep stocks for a long time. Then there are traders, or you call them speculators, who want to buy today to make fast money, which normally I think is very, very difficult. You don't tend to make money so easily. Then there are arbitragers. Arbitragers are people who normally would buy in one market and sell in another market. Like, to give an example, gold that trades both in India as well as globally. The price of gold sometimes fluctuates between the two countries, but over a period of time they converge. So with technology and access to global markets, you buy in the market where it is cheaper and you sell in the market where it is expensive. So you make that risk-free return over a period of time. They are called arbitrages. Then there are hedges who, like, if you have a portfolio, say, of 10 lakh, but you believe that, okay, over a period for next sometime, I think markets will fall, then you can go and hedge your portfolio, which indirectly means you can go and sell the Nifty, or you can go and sell your stock, not deliver it, hoping to make some money if you go right. They are called hedges. Now, what has happened also, why is the volume surged, is also the fact that a lot of trading or transactions have happened in your language via the nothing but a computer-based algorithmic language. So that it is basically a language which is deployed on the. I think you muted me also, so I unmuted myself. So it's basically to execute orders as per the instructions of the client on the exchange platform in a particular format. So suppose you, a very big mutual fund wants to sell, say, 100,000 shares of Reliance, but tells you, okay, sell it throughout the day. You can't sit in front of the screen and keep selling 100 shares of Reliance every minute or whatever. So you develop a computer algorithm, you put that instructions in the algorithm, and the algorithm keeps executing. So a lot of this has helped the volumes go up. Execution has become very easy. A lot of clients, foreign clients as well as domestic mutual funds, have started putting orders from their own office. It's called direct market access. It's a DMA. So if they don't want to let the world know or the broker know as to what is it that he's buying or selling, he enters your server via the computer, his own DMA, the algorithm, and he puts the order. So there's a lot of transparency that has happened over a period of time. And this has helped increase volumes to a very great extent. Markets today open from 9 to 3:30. The other thing that has happened in the current environment is also, again, you will understand it better, in HFT, which is called high frequency trading. Today, a lot of people, so as I told, there are different kinds of traders or different kinds of people who want to trade the stock market. The high frequency trader, he is not concerned with a particular stock on its, whether it is a good stock or the bad stock. He's concerned that there should be a big volume on the stock. So he's developed a strategy, he's developed a computer language, an algorithm, which buys and sells that stock with a gap of 5 paisa. But the kind of volume that they do, that is why it's called high frequency trading, enables him to make money by buying and selling throughout the day. So he is an animal who likes volatility, because more the volatility, the more he buys and sells. But the important thing for this kind of an animal is speed. In today's world, in current capital market, every broker is trying to ensure that the clients gets very good speed while executing his order. That is why the exchanges have set up something called colo, that is co-location server. So Emkay server today is also located in the NSE, where the speed that a client gets to execute his orders goes in your language, micro, mini seconds, and it can be actually be measured. So the faster you can execute, the more the money he makes. And honestly, sometimes a retail investor doesn't even see the price on the screen. It just bought and sold before somebody puts the order. So technology in today's world is taken a huge leap in capital markets, unlike the past. Besides, today's markets are a lot open to the world. So one can definitely make a statement that foreign institutional investors, to a certain extent, dominate the markets. In the last 5-6 days, those who track markets have seen the markets keep going up. Or you can say the Nifty or the Sensex is going up. One of the reasons, only one, I'm not saying that is the only reason. One of the reasons is also because the foreign institutional investors are buyers on a daily basis. There can be many reasons as to why they're buying, why they're not buying. So we as an exchange or as a country, we are being called as emerging markets. US is called as a developed market. So in emerging markets, there are a lot of funds globally. So there's a fund in US, we call it, say, Vanguard. Vanguard is a very big fund in the US. So they collect money from clients and they say, we will put this money in emerging markets. And the kind of money that they collect runs into billions of dollars. Then when they say, okay, I'm collecting this money to be put in emerging markets. So even China comes in emerging market, India comes in emerging market. That is, there are countries which come in emerging markets. So if they've collected 100 rupees, India normally gets 8-9 rupees from this emerging market fund. Now you can imagine if the fund is so huge, even a 0.5% increase to India allocation or a 1% increase to India allocation moves money to a great extent to India. That is a time when liquidity drives the market. So you might have, you're right to say, okay, fundamentally the markets are not strong, but liquidity, cash is chasing stocks and hence the market moves up. That is one very simple example. Markets are not so easy. I'm just trying to make it sound easy as of now. What has also happened in this last 4-5 years is that a lot of money is gone into ETF, okay, which is called an exchange traded fund. So what does an ETF do? So people like you who find it very difficult to understand markets, you don't know what to buy, you don't know what to sell. So that in developed markets, they are called ETF. So what you do, you put money in this fund called exchange traded fund. That fund does nothing other than buying the index constituents as per their weights. So let me explain this very simply. So today you see Sensex, okay, which is 140-year-old exchange. And Sensex has 30 stocks. Suppose you go and say, okay, I want to put 5 lakh rupees in an ETF which tracks the Sensex. If the Sensex goes up, you make money. If Sensex goes down, you lose money. So a fund manager puts the 10 lakh rupees that you have given in those 30 shares as per the weight which moves the Sensex up and down. So if the Sensex goes up by 500 points in a day, or say 1% in a day, your portfolio also goes up by 1% in a day. So ETF globally has become a very big word. Today, in US, 35% of, I think, money is gone into ETF. And a lot of this ETF moves into emerging markets, to developed markets. But the downside of this is, so in 2017, when there was a huge bull market, Okay, a lot of money came via the ETF. So ETF doesn't care whether this stock is expensive or this stock is cheap. It just buys the 30 stocks of Sensex. At the same time, when people withdraw money from an ETF, which must be tracking the emerging markets, the money just goes off. Okay, it doesn't bother whether Reliance has fallen by 10%. It just wants to sell. That is the time when everything goes down. And we wonder what's happening. That day, if you see and track the FII figures, it will be a huge negative. So that is the time when liquidity can move markets anyway. So passive investing is something that is gaining more and more importance than active investing. Active investing is when you give money, say 10 lakh rupees to a person to manage, then he decides, okay, let me buy Reliance, let me buy Tata Steel, let me buy some other stock, some other stock, some other stock. And then every day you will see that portfolio go up, go down. That's called active. And then he may sell off Reliance one day, and he may buy Infosys the other day. So that becomes a huge challenge sometimes. And it has been seen over a period of time that active investing doesn't help a lot. It only, there's a law of average. But you should understand, markets are like a big cycle. Every 5 years, you get a big bull market. I'll just take back a little bit more to history. I think you must have got a bit bored as to what I'm speaking. So, in the US, in 1929, there was this Great Depression of the US. There was a trader, and I would recommend you read about this trader, read about his biography. It's called, he was called Jesse Livermore. Okay. Those days, he was also considered as the big bear. This two terminology, bulls and bears. Bulls always want the markets to go up. Bears always wants the markets to go down because they sell the markets. Bulls buy the market. So he made huge amount of money by going short the US. The US economy, I think in 1933, when it hit at its peak, some 15 million people in the US lost job. That must be some 20% of the US population. And Jesse Livermore made so much of money that even Morgan Stanley and the US president had to come and beg him, okay, why don't you cut your shorts? Industrial production was down, unemployment was peak, everything was going wrong. But then everything comes back. Markets bounced. The same happened but one more thing you should remember, Jesse Livermore, and there were five big US guys who once met in a hotel in the US. They were the 5 richest guys in the US who used to control the US economy. I think all 5 of them suicided. Jesse Livermore shot himself in some hotel in Manhattan, New York in 1939 or 40. Because they made so much of money and then they finally kept on speculating that they lost all the money. And that's why I believe that speculation doesn't take you anywhere. So for most of us, the latest one would have been 2008, the global financial crisis when Lehman Brothers went under. So that time, Nifty was, since Nifty trades, was around 6,000 points. And by February 2009, it went down to 2,700. February 2009. By December, or say you can say in 18 months, it was back to 6,000. So from 2,700 back to 6,000 is actually doubling. Okay. Same thing has happened recently. 2017 was like a huge bull market. Something like reminded you of 2007. You go buy anything and it goes up. 2017, you come in the morning to your office or you call your broker. He tells you buy this, you buy and you make money. That was the craze of 2017. Then 2018, a lot of people realized, was this is crazy. 2019, we all again realized this is crazy. Then came COVID. What happened in COVID? Nifty at the peak, say in February 19 or middle of 19 was 12,000 Nifty. I think Sensex was 40 plus. Since we trade Nifty, it's easy to remember Nifty. Nifty in this COVID environment or 2020 went as low as 7,600. And there are various reasons for that. It is just not the virus. There's a lot of reasons as to how this market trade. I will surely talk about that a little bit. Today, the markets are at 9,800. The Nifty is at 9,800. It's hardly 4-5 months. So sometimes I believe that, there's no sense to panic when the whole world says everything is over. Infosys, if you are an investor, I think I have it written somewhere. Infosys, which when it came in 1993, I think 100 rupees invested in Infosys in that time, 1993, I think is equal to something like 4.5 lakh rupees now. So this science of compounding is very big in capital markets. Even today, when Nifty is down nearly 20% from its peak, there are a lot of stocks which are at 52-week high. Means in the 1 year, how the highest price ever. They come back close to that. There's a big debate in the world today on how to invest. The past theory talks about value investing and one is growth investing. So people who follow value investing, they believe that there are a lot of companies which have a lot of value in it. So let's buy those stocks. And even if the markets go down a lot, we will keep buying that because sometimes it will give you a return in its true value. There are others on the growth side, they believe, no, this value is okay. You have to identify companies who have a very nice growth. So what is the return on the capital that has been put on the company? Is it growing every year, giving a good return of 20%, 25%? Is the top line growing today, every day, every year? A classic example I'll tell you. And is demand. Now that stock, honestly, in the minds of every person today is very expensive. It's trading at something like, there's something called PE ratio, price to earning, which normally we look at something like 20, 25 for normal companies. DMart is trading at something like 100, 120 PE. Is that expensive? Oh, everybody believes it's damn expensive. Very expensive stock. But that stock keeps going up. In the same way, if you consider stocks like HDFC Bank, Nestle, 3M, these are all stocks, Asian Paint, these are all stocks which must be trading anywhere between 40 to 80 PE ratio. And they never fall. So sometimes, most of the time, people who invest in these kind of stocks, they say, I get good sleep in the night, I buy good companies, and they will always be expensive. So I have no concern, no challenges in buying these kind of stocks. But one should understand that, when people like our age today, I don't know how many of you are my age or Jay Bala's age, when our parents used to invest money or even put money in fixed deposit in the bank, we were expecting 15%, 20% fixed income return. Today, my parents, whenever they thought of putting money or saving money, they thought, okay, if I have so much money and if I get 15% return, I will have a good life. I can live my retirement life. Today, honestly, it's unfortunate that the fixed income or the bank fixed deposit is anywhere between 5.5% to 6%. Deposits many places in the world are negative or as good as zero. So the big question which keeps coming to the minds of many of us as to what do we do with our money? How do I live? There comes an answer or a question, I would say, that which each one of us have to answer as to whatever money we have, how much you want to put in, I would say, three categories. Whether you want to put, how much money you should put in fixed deposit, how much money you want to put in equities, how much money you want to put in unproductive assets like gold, silver, or house. It all depends on each one's appetite. Today, wealth management, which has become a big word, because it is already a big word in buzzword in the developed economies, is getting a lot of importance in India in the last 5-6 years, where you go to a wealth manager and you tell him, okay, what is your risk profile? Are you happy to take risk? Do you have ancestral wealth that allow you to take risk? That will help him answer. Either you become conservative, it will also be in your nature. So when you say I'm conservative, I don't want too much of return, he might put 60 to 70% of your money in fixed income, government G-Secs or AAA paper, which gives you 7.5%, 8%. You will put only 30% in equity. If you say I'm moderate, they will say, okay, let's put 50% in fixed income, 50% in equity. If you say, oh boss, I'm aggressive, I like to make money, I have a lot of risk, I can take risk, they will advise you put 70% in equity. Let's put 30% in debt. So each one of you in today's environment has to decide as to how much money you want to put where. It's never advisable to put all the money in one basket. Never. Whenever you feel that a big bull market has come, okay, you press the button more. You put 85%. 2017, people made 60, 50, 60, 80% return. But you should appreciate that over a period of 5 years, you need to moderate your return on your capital. If you have 100 rupees, you need to understand that over a period of 3 years or 5 years, this 100 rupees, you should be happy if you get anywhere between 14 to 16% return if you behave well and if you invest sensibly. Today, if your fixed income is giving you only 5.5%, 6% return, how do you expect something to give you 25% return or 30% return? It's not possible. That is something which all of us need to understand a lot. I think it's more than 40 minutes gone and a lot of you there's a lot to talk actually. I can do a session with some of you independently and we can have a two-way interaction later on. But I would like to definitely tell you that where the future is. The future is that passive investing, exchange traded fund is going to play a bigger role over a period of time. Mutual fund investing, okay, is something which has taken a very big shape in the last 3-5 years because a lot of investors have lost a lot of money and there are various reasons for that. So if you don't know how to put money where, you should go and deploy your money in mutual fund. And this doesn't make sense that you go and put all your money on day one. And at the same time, don't think, oh, today the market is at 9,800 Nifty, I will wait for the market to fall. There are fools who make the market, who can time the market or who buy at the bottom of the market. You do a SIP, which is systematic investment plan. You identify funds who have given you decent return over a period of 3 years, 5 years. See, here you should understand, you don't go buy a fund just because it has a very good name. You have to understand who's managing your money. So like today, HDFC Mutual Fund, okay? There are a lot of schemes in HDFC Mutual Fund. There's a large cap, there's a mid cap. But you should understand who is managing that large cap fund. So for example, the large cap fund over there is being managed by Prashant Jain. So you should know the history of Prashant Jain. Okay, has he given good return over a period of 5 years, 10 years? Because tomorrow, if he moves out and goes to some other fund, then the money is not managed by him. Money is managed by somebody else. So it's very important to know who is the fund manager who is managing the fund. So mutual fund today, we have at least something like anywhere between 8,000 to 10,000 crores coming into mutual funds every month. So you do a systematic investment plan. You can go as low as 1,000 rupees. You can go as high as much as you want. But equity investing is something that you should not forget to do. As I told you, 100 rupees put in Infosys or Reliance, given a phenomenal return. Now, what you should not do, that is also very important to know. First, most important thing, you should never buy on tips. Okay, that's the most scariest thing. You can lose a fortune. In the last 2 years, there are so many big houses that have gone under. Who would have thought Yes Bank, 1,000 at one point of time, Jet Airways, the SR or the Videocon, why go far? Why not the Reliance Capital, Anil Ambani group? So don't ever buy getting bought into by somebody. Okay, this is the best stock. No, don't never do that. If you have the time, take out half an hour. If I tell you, okay, go and buy Britannia, I'm sure there's so much of research on Britannia that's available on net. At least try to understand why you're buying this stock. That's one thing very, very important. I told you markets fell as low as 7,600. This is one very fundamental rule. Never borrow and invest. Never, never, never do that. You will lose your capital, you will lose all the money that you made in life. So when markets fall big time, what happens? I'll just try to explain in a minute. Suppose you have 1 lakh rupees and you make 50,000 rupees by your own self. And then the greed comes in. You come and give that 1,50,000 to Prakash, me. And you say, can you lend me money against this portfolio? The normal rule in the markets are that, okay, 50% is what we can give you. So I give you 75,000 rupees more. You go and buy more stocks. Okay, so now you have got stocks worth 2,25,000, where you owe me 75,000 rupees. There's an interest which keeps going. Suddenly, markets fall. Your 2,25,000 becomes 1,75,000. Value of your portfolio. I come to you, I tell you, hello, I need more stock or I need money to protect myself. You say, I don't have. So what do? To protect myself, I go and sell your stock in the market at any price. Because I need to protect my 75,000. After that, whatever is left, I will give it to you. That's called leveraging. Never ever leverage in life, come what may. All companies who borrowed or who are in debt are today in a disaster mode. You have to stay away from the greed. That's very, very important for me. Also, whenever you think you have taken a wrong decision of buying a particular share on somebody's recommendation, never feel ashamed to call yourself a fool and sell it off. You have bought something at 100, it's gone down to 90. Oh, I think I should buy some more. 80, I think I should buy some more. 60. You're creating a tree. And then finally at 50 you sell off because somebody has made a fool of you. And then from 50 it starts going up again at 70. So again you buy, again it goes down. Never get into the game. If you cannot track your portfolio on a daily basis, in spite of so much of technology available on Google here and there, you need to then give your money to somebody else to manage. And the best person to manage money for small time investor is give it to mutual fund. The last one thing that I already told you, never ever increase your expectation on return on the money that you invest to an amount that is very difficult to achieve. So there are lots that I can talk about, but I just thought, let me just take you through some basics of markets. Now today markets are up, and a lot of you people will be thinking the economy is in bad shape. I'll tell you one or two, three things what people think on the ground. So people believe that India will become a very, very big story. I also believe. Why? Because globally, a lot of countries are trying to get out of China and move manufacturing to other countries. And I think India has a very good opportunity there. But the big challenge there is how well we execute. Because we don't rank very high in the index as to how easy we can do business in India. There's a huge challenge there. If you have read, some of you must have read that the US is asking US is huge money, a lot of pension funds, a lot of government funds, a lot of funds of big sizes. They have invested a lot in China. As I told you, there is funds which have, say, $50 billion to invest in emerging markets. US is convincing all of them, or even making noise that stop investing in China. But when you have an emerging market fund, you have to invest in emerging market funds. So even if 1% of that money moves away from China to India, a lot of money coming in. So markets, always discounts the future. The sentiment about lockdown opening is huge. India has been locked down only for 2 months. We understand the economy is going for a toss. And I can tell you, before we started this session, I was telling Utha that the stress of how this lockdown will be open is much, much more than the lockdown itself. Because the MSME thinks, okay, first you had a challenge from where we get capital. So the government is giving you capital. Now the second question he says, where will I get labor? So he gets labor also. Then he says, where will I get raw material? Then he gets raw material. Then he manufactures. He gets finished product. He says, who's going to buy? So the stress, even for us, we have X number of employees in our organization. So we have decided we won't let more than 20% come to office for the first month. We all have to live with this virus. That's something which I understood. Once I think the German President Merkel had said 60% of the world will get affected by this virus or will test positive. Positive doesn't mean that it's fatal for everybody. It's not. You will recover. The recovery rate is good. Mortality rate is very low. So this is very short what I could talk about basics of markets. Foreigners are putting money, liquidity chasing stocks. See, one more thing which I just want to say, when you see Sensex go up or the Nifty go up, it's also important to see the market in a broad market. Whether if there are 3,000 shares listed on the exchange, is it only the 30 stocks have gone up or 2,000 shares have gone up and 1,000 have fallen? That is a comparison of broad market. If only 30 shares go up, so the Sensex looks high, but actually your portfolio must be in a bad shape because the rest of the stocks haven't moved. And this Sensex and Nifty, you should make an effort to go to the NSE website and the BSE website and see what sector is more heavy on the Nifty or the Sensex. Like financials, the banks, the financial companies, the NBFCs, they have a huge weightage on the Nifty. So if the banks move up, the bank stocks move up. The Nifty moves up automatically. Stocks like Reliance, Hindustan Lever, ITC. Once Reliance, I remember a long time back, used to have a weightage of 12%. So if Reliance moves, the next Sensex is to move a lot. So it's important for you people also to go in and see what these constituents are, to see market from a broader perspective. Invest in stocks is what I would recommend. Don't do tips, don't leverage, don't take debt. A lot of research is available, quant is available, data is available. And never have a feeling of the young generation, like my daughters tell me, FOMO, fear of missing out. Never. You will have enough opportunities in life. Don't think, oh, I missed this stock. Nothing is missed in life. You'll get an opportunity to buy, and every 5 years there's a cycle to make money. Wait for the cycle, but keep investing in mutual funds if you think so. All your MNCs are very expensive, but it is always good to be on the main line. Okay, it's always good to buy large stocks, because if whatever happens in the world and you want to exit your portfolio, if you buy stocks like Reliance or Tata Motors or Hindustan Lever, ITC, blah, 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 you can sell it off in, second. But if you buy mid caps and small caps, it might be very, very difficult sometimes for you to sell, because many a times these stocks are at seller fees down. These are percentages decided by the exchange, that if the lower circuit is 10%, and the stock is 100 yesterday, it can't go below 90 today. So you suddenly have, classic example is future retail, if I'm not wrong. It was quoting at 400 rupees and it went all the way down till 65. So if you are holding 100 shares and you have to stand, and I want to sell today, I want to sell tomorrow, I want to sell tomorrow. If your luck happens, the stock can go. If it doesn't, then it's your bad luck. So it's always good to buy large caps. Unless you are a value investor, some of you might be smarter than me to identify stocks and invest in them. There are enough stocks. So it depends on your risk appetite as to what kind of a portfolio you want to build over a period of time, how much risk you want to take and invest. So I think a lot of my time, I have spoken a lot. Only thing I can say is stay home, stay safe, get the fear out of you, and I'm open to answering a few questions if needed. Sudha, is that fine?
Yes, sir, it's fine. Participants, if you have any queries, you can post in the chat box, or you can unmute yourself and ask the queries.
I hope I was not too complicated.
No, sir, your messages, 3 messages are very awesome. Never borrow and invest. Stay away from greed. Never ever increase your expectation and the money you invested. Very valuable message.
Perfect. These 3
yes,
are
sir.
the most important points of my teaching today.
Yes, sir. Very valuable messages.
You learn it very hard. You learn it in a very hard manner.
Yes, sir. Thank you so much. Participants, you have any queries to ask, you can post in the chat box, or you can unmute your mic and you can ask.
Hello, sir. Hello.
Can you speak a little loudly, please?
Good evening.
Good evening.
Hello. Hello, sir. What is now the gold rates are high? Gold rates hike are too much. Then is there any link between the gold rate and stocks, sir? Gold rates are rising day by day. What is the link between the gold rate and the stock market?
So gold, I'm a big lover of gold and silver. So gold, people, when do you invest in gold? When you normally have fear of currency, or when there's a war, and when you expect. So gold is considered as a safe haven. So everything is in a turmoil. People search, where can I put money which will not fall too much, and where my money is secure. So as I said, equity markets are not so easy. Gold, the world says that the gold price can go up to 50,000 or 55,000 is what they're predicting. It has moved a lot. It has moved from 35, if I'm not wrong, 35 to 46,000. I think you should stay invested in gold for some time, but to buy at this levels, I don't know, because the day people like to invest in stocks, people might sell their gold and want to make more money, because gold doesn't give you the kind of return that equity markets can give you. But I can tell you one thing: if you want to invest in gold, the government is coming out with these bonds. I think it makes sense to buy there also, because at least gold is an unproductive asset. So if you buy gold, you're going to definitely keep it in your safe or cupboard. The government bonds, which is a 5-year lock-in, you can't sell for 5 years. But the government also gives you 2.5% interest, and I think it's tax-free. I will send that. There's a research by, I think, HDFC Security. I can send that to Sudha, and she can forward it to all of you.
Sir, there is one more question on the chat box. How does the future of mutual funds look like in the wake of COVID-19?
So the way to answer it is that in spite of COVID-19, the SIP, the systematic investment plan, which the retail investors are putting into money into mutual funds, I don't see it as a big challenge. Markets always discounts the future. So we are in 2020. You don't know, 2022, it's a cycle. So in 2022, will the Nifty be 14,000? So the mutual fund will perform. But you, as I said, you definitely want to know who is your fund manager, who is managing your fund. So honestly speaking, like for me, I can do direct investing, but it's always good to put money in mutual fund, because I might buy 10 stocks. The mutual fund buys 50 stocks or 100 stocks. So at least the risk gets spread out. Okay, my 10 stocks all can fall, but 100 stocks all may not fall. So I don't see any reason. So there are Axis Mutual Fund is an outperforming fund. Then there is Mirai fund. These funds are good. I can send Sudha a report on mutual funds, which I think one should look at. She can forward it to all of you.
Hello, sir. One more question. Shall I ask?
Yeah.
Sir, during these times, it's somebody told that it's not advisable to keep money in the bank or in the PPF account. Is it so? Is it advisable to keep the money in the bank or in PPF? Shall we withdraw it? Because the government may take any decision. Some rumors are there.
So putting money in banks is like buying. If I have an analogy, it's buying stocks which are C category. If you put money in cooperative banks, that's the way I look at it. Okay, today, don't put money in banks. Money in banks is totally safe as long as you know which bank you're banking with. Today you can't expect a public sector bank like say SBI, State Bank of India. Tomorrow, if State Bank of India fails, then I don't think so we'll have an economy in India. Or HDFC Bank or ICICI Bank, Axis Bank, these are kind of banks where you need to keep your money, and they are very, very safe there. Because these are banks of size. If these kind of banks face challenges or they go under, then we are in very deep trouble as a country. Same is the case in PPF. It's public money. I don't think so. These are instruments where one need to get worried about. But if you put your money in, so a lot of people had a lot of trouble putting money in Yes Bank. It's a challenge. But everybody knew Yes Bank was going under, or not going under, but is in deep trouble. It's very important that you put money in the right bank. Be with the big guys.
Then how to find the right bank, sir? That's also a question, no?
Okay, I'll tell you. If you like public sector, you go to SBI, State Bank of India.
Okay, sir.
If you like private, go to HDFC Bank. HDFC Bank.
Okay, sir. Thank you. Thank you very much, sir. Thank you.
My pleasure.
Ma'am, shall we wind up the session?
Yeah, ma'am.
Swatika, please give your vote of thanks, Swatika.
Okay, ma'am. Good evening to one and all. I thank the resource person of today's program, Mr. Prakash sir, Managing Director, Emkay Global Finance Limited, Mumbai. And he has explained elaborately the status of capital markets, the present, past and future. And he has explained how the technology has changed the entire stock market. And now I think we all are able to access the global market. His talk was highly informative and useful. So on behalf of our institution and Department of Computer Science and Engineering, I wholeheartedly thank the resource person for his valuable speech. Thank you one and all. Thank you, sir.
Thank you very much. My respects to all the professors, faculty over here, and regards to all the elders. Thank you very much.
Thank you, sir. Thank you for spending your valuable time, sir. Thanks a lot.
My pleasure. My pleasure. Thank you very much.
Okay, sir. Thank you so much.